a combination of different investments. Look, if there were only 5 investment options available within your plan, I'm pretty sure there are more than 5, but let's suppose there was only 5. And one of those 5 is the absolute best place you could have your money invested in that year. And one of those 5 is the absolute worst. Is it better to put all your money in one place and be right 20% of the time? Or to, let's say, put 20% in each place, and even though we know one is going to be bad every year, we're going to be right 80% of the time. And even if 2 were bad, we're still positive 60% of the time. That's what the importance is by choosing a variety of investment options. Finally, rebalancing your portfolio, and we'll talk a little bit about that in a little bit, and as well as consolidating your funds. That can give you a little bit of flexibility in case you needed to receive a loan from your retirement plan. And then finally, monitoring your investment choices. Remember, it's not timing the market that's the most important thing, but it's time in the market. The longer that you have in there to allow your money to be growing for you is going to be the most important thing. And here in the next slide, eventually, let me hit this again. Sorry for the technical difficulties here. There we go. Here you can see, for a lot of you, this is either going to bring you fond memories of your grandmother's quilt, or it might bring horrible nightmares of high school chemistry. I guess it depends on how your childhood was. But this is what the market has been doing for the past 20 years. From 1991 to 2010, the top being the absolute best place you could have had your money, and the bottom the absolute worst. Now, each color here represents a different segment in the market. And don't worry what each of the colors are, but the whole idea behind this is that many people make the mistake when it comes to investing to put all their money in what they grade the year before. So if this was the year 1992, a lot of people would have put their money in what they grade in that upper left-hand corner, 1991, that did a return of 51%. And if that was the case, take a look at what would happen for the next 20 years if that was your school for investing. Ronnie, we can hit the next button there. There we go. You can see that for the next 20 years, there is no rhyme or reason when it comes to investing. You can pick any color on the board there, and you're going to realize that it's just going to be all throughout the board. But a better approach, as mentioned before, is represented in that white box, which is a diversified portfolio. Now, being diversified does not necessarily mean you're going to make money every year. As you can tell, you were never, ever on top, but also you're not going to be in the bottom either. And this is going to help give you a steady, sustainable growth, because I will tell you this, after the 2008 recession, I've had a lot of people come and tell me that there really is a price to pay to being able to sleep at night. And if your approach is to invest your money in what did great the year before, I can almost be certain that you're always going to be 1 year too late when it comes to investing. So make sure that you do have a diversified portfolio. Now, let's go ahead and go to the next one there. Right. We'll go ahead and go back to the basics, and let's hit the next slide there. We'll talk about how to read the investment options that are available within your plan. We call it a ladder system from bottom to the top. The bottom being the lower risk, which also gives you a lower return. The top being a higher risk, which obviously can give you a higher return, but also potential higher losses in that respect. Oops. 1 second here. Ronnie, I lost a slide here. Oh, there we go. The bottom there, your short-term fixed options, these will be your money market, your savings accounts. This is where people want to make sure that $1 will be $1 in 1 year or in 2 years from now. You can see on their treasury bills are included in that, as well as CDs or certificate of deposits. These are typically not investment accounts. What do I mean by that? Well, these are savings accounts. You want to make sure when you put money in here is you're simply saving. People don't put the money in the short-term fixed expecting to have an investment or a large return. Those above, fixed income, large, small, mid, equities, people are investing their money in here hoping to make a little bit of return. So your fixed incomes will be your loans, whether to companies or government entities. Right above that is the beginning of your stock. So you have your large U.S. equity or stock. They're used interchangeably. But these are invested in companies inside the U.S. Many of you have heard of these names. It's also color coordinated. So large U.S. equities are in blue. You may have heard of the phrase blue chip stock. These are companies like Bank of America, Dell, Microsoft, Firestone, Ford, companies that are not trying to reinvent the wheel. They're good at what they do, and they're going to stick with that. The ones right above, small and mid U.S. equity, these companies you may not have heard of. These have small assets, and these guys are trying to reinvent the wheel. They don't have a name for themselves, and they're trying to become large U.S. equities eventually. This is where you would have seen Microsoft back in the 70s, where no one knew about Microsoft and software technology. As the story goes, Microsoft became the sole provider of software for IBM computers. Now Microsoft is a household name. Now, can you imagine what would have happened to Microsoft or Bill Gates if he never received that contract with IBM? Do you think Microsoft would be where they are today? Well, probably not. But as history goes, they are a large U.S. equity firm. The reason why small and mid-sized companies are up higher in the ladder is because you can have high risk with those, but also you can have a higher loss. You can go big or go broke. And then you have international equity. This is investing in stock of companies outside of the U.S. Toyota, for example, is based out of Japan. Mercedes-Benz in Germany. Cemex, which is the largest cement manufacturing in the world, based out of Mexico. L'Oreal, based out of France. You may ask, well, a lot of these companies I know, Sony, for example, why would Sony be considered a higher risk in a small cap U.S. stock? Well, the reason is because you do have certain levels of risk which you're not going to have when investing inside the U.S. Foreign exchange risk, as an example. Investing in Sony, you're investing also in the Japanese yen. Well, converting that back into the U.S. dollar may not be in your favor at that particular time. So that's a level of risk which you don't have to consider investing in the U.S. You also have political risk. What if you were investing in an oil company in Venezuela and Hugo Chavez comes and nationalizes all the oil companies? Well, you have no political or legal say in the country of Venezuela. So these are things that need to be taken into consideration when investing internationally. Let's go ahead and go to the next slide. Also, you want to make sure that whatever investment options that you pick, that you make sure you keep them balanced or properly allocated. Here, as an example, on the left-hand side, we see an original allocation where a person put 50% in stock and 50% in bonds. Well, over the course of time, with what the market has been doing, it could very well be that in a year or 2 years from now, your portfolio has 75% of their money in bonds and only 25% of the money in stock. Well, that's what we call out of balance. It's definitely not the original allocation that you chose. And so our recommendation is to go back every quarter or biannually or annually to make sure that your portfolio is properly allocated. One of the tools that are available with the Principal Financial Group is you can choose an automatic rebalance where you can go and have it set up at the time. You go online to rebalance, or you can have it set up to rebalance every 6 months or every year at your leisure. It would be done automatically for you, and that's also a very important thing. Ronnie, let's go to the next slide here. And of course, market volatility. Again, one of the biggest mistakes a lot of people make when it comes to investing in the market is they expect to, or they hope to withdraw their monies before the market falls and then hopefully put their money right back in when it starts to creep back up. Well, remember, it's time in the market. It's not time in the market that's the most important thing. And here you can see how the market has done for the past 20 years. In the past 20 years, the market has had an average rate of return of 9.2%. In fact, we can even go farther back. We can go back to 1961. And from 1961 until the end of 2011, the market has actually averaged 9.7%. Now think about that. What were some of the things that have happened over the past 50 years that would have been a flag or an indicator for you to pull out of the market? We can go back to November 22nd, 1963, when JFK was assassinated. Probably one of the most horrible times to invest in the market. You had the 1973-1974 oil embargo crisis, where people were waiting hours in line for gas. And we had stagflation back then. You also had the savings and loans crisis in 1980. 1987, October of 1987 specifically, the market crashed. And one day, the market lost 26%. You had the 1994 recession. You had the dot-com bust. You had 9/11. And despite all of those reasons why you should have, quote, not have invested in the market, you would have averaged 9.7% with reinvested returns. Now, if you missed the 10 best days, you can see on there that you would have not made 9.2% without reinvested dividends. You would have only made 5.4%. And if you missed the 50 best days on top, well, you would have actually been negative 2.6%. Mind you, I want to add that the average day trader in the same time period has had an average rate of return of about 2%. Why is that? Well, that's because we have two emotions which we have to battle when it comes to investing. And we are emotional people. We have to battle the emotion of fear and the emotion of greed. And we saw the apex of greed back in 2005 when people were buying homes and being over-leveraged in mortgages when they should not have. We also saw the apex of fear in 2008 when people were selling out of the market when they should have just stayed put. And mind you, if you would have kept the same allocation that you had in 2008, most likely after 3 years you would have recuperated. Not so if you had all your money transferred over to your savings account, because the average savings account over the past 10 years has been making less than 0.5%. Let's go ahead and go to the next slide here. So when it comes to picking your investment, it's a simple matter of understanding what type of investor you are. Whether you like to build your own portfolio and you like to monitor your own investments, or you want a fast and easy way to pick your investments. And of course, there's no right or wrong way of picking your investments. It's just a matter of preference. And remember, whether you're going to be having some help in picking your portfolio or building your own, this is not set in stone. You can have this change at any time. Let's go to the next slide here. One of the tools that we have available for you online or in your workbook is this investor profile quiz. It consists of 8 questions. It's not a right or wrong type of test, but these 8 questions are to help determine what your risk tolerance is when it comes to investing. So what you do is you take these 8 questions, you answer them as honestly as possible. And you can see on the bottom right-hand side of the second page, you see a matrix. And what you do is each column represents how many years away you are from retiring. I'm 16 plus years away from retiring, so I would be the last column on the right. And if I added up the points that I've received here, and let's say, for example, I received 40 points, you may not be able to see that, but I would be a Roman numeral 2. And so you have from Roman numeral 1 to Roman numeral 5, and each of those Roman numerals represent your level of risk. And within your book or online, you can see a suggested pie chart as to how you should have your money allocated throughout the different investments available for you. 1 being the most conservative, 5 being the most aggressive. Me being Roman numeral 2, I will be a moderate conservative investor. And you can take this pie chart as a suggestion as to how you should have your money allocated within your funds. And of course, understanding that or doing that, let's go to the next slide here. It's understanding what type of investor you are, and determining that will help you determine how you should have your money invested. And of course, the best recommendation would be to always work with another advisor. Even myself as an advisor, I always work with another person as well. Simply because we don't want to have any decisions based on emotion. And working with an advisor will make sure that the emotional side is taken away and any investment decisions are made on a rational basis. Let's go to the next slide here. We're going to determine if you're saving enough. And one thing that I want to talk about is when it comes to your 401k, remember your 401k, let's go to the next slide here. There we go. Thank you very much. Keep in mind that your 401k helps your money grow on a tax-deferred basis, and that's one of the biggest advantages you have versus a regular savings account or a regular brokerage account. Whatever money that you deposit into your retirement plan is growing on a tax-deferred basis. What that simply means is that you haven't paid any taxes on any principal that you have contributed into your plan. You can see the matrix on the right-hand side. If you have a person making $35,000 a year, contributing 8% into their retirement plan, well, 8% is $108 on a bi-weekly basis. If that same person decided, no, I would rather take that 8% and invest it outside in my savings account, that person is not going to be receiving $108. After taxes, and we're assuming a tax rate of 25%, this person is only going to be receiving $80. And you have to ask yourself, well, what's better, having $80 working for me or $108 working for me? And the answer is $108, not taking into consideration what investments we're looking at that. And that's where the compounding interest will come over the course of time. Also, there's a matter of tax savings. Here in this example, this person is saving $27 every paycheck, which amounts to a little over $700 a year that they saved in taxes, not taking into consideration the $80 that they contributed into the plan, or let me just do some quick math here, $2,100 that they have working for them in the retirement plan. Working tax deferred, I'd like to add, not tax free. There are two things sure in life, and that's death and taxes. You will eventually have to pay taxes on this, but in the meantime, this money is growing tax deferred in the next 10 years, 15, 20, 30 years, depending on how long you have this money working for you. Let's go to the next slide, please. And you know what? I've never had anyone come to me and say they made a mistake of putting away too much money into the retirement plan. I have yet, and knock on wood, hopefully it won't happen, I've never had anyone point their finger and say, it's your fault that I'm a millionaire. What am I going to do with all this money? Curses in mine for having so much money to spend. I have had people always say, if only I put more money than less over the years. And that's what this example is giving. We have two people, Elaine and Phil, and both making the same amount of money, and both of them are putting away 8% of their income into their retirement plan. But Elaine does something different. Elaine, over the course of 5 years, decides to increase what she's contributing into her retirement plan by 1%. So this year she's putting away 8%. The next year she increases it to 9%. The next year to 10%, and increases it by 1% every year. Phil, on the other hand, decides to keep it at 8% and not increase. Well, you can see over the course of 25 years, when both of them are finally able to retire, that 5% increase over a course of time, not all immediately, has given Elaine an extra $170,000. I don't know about you, but I would like to have an extra $170,000 when it comes to investing. Now, 1%, it may not be as much as you think it would be. It can be as little as $4 a day. And so the rule of thumb is, how can I save $4 a day so I can have a little bit of extra money for my future? One of the easiest things that the government has done for us last year and this year is drop Social Security tax by 2%. Back in 2010, we were paying 6.2% in Social Security tax. Now it was 4.2 back in 2011, and it's finally been extended to the end of the year. Don't get used to that. You didn't have that back in 2010. You're surely not going to have that extra 2% in 2013. And so may I suggest to everyone is to increase your retirement contributions by 2%, which is what you would have had taken away for Social Security tax anyway. It's one of the simplest things that we can do to have a little bit more in our retirement plan. That may be one less coffee per day, but at least you're going to have a little bit extra in your retirement plan. I don't have your savings plan here in front of me, but an important thing to do is from time to time go back and take a look at your retirement plan summary. Look at what investment options are available. Make sure you understand your eligibility, your vesting schedule, what your loan requirements are, because it's better to be in the know than not. Let's go to the next one here. And finally, we're going to talk about staying on course, what tools are available for you. So going on the next slide, you want to make sure you stay focused. You want to revisit your contributions at least annually. Look, just because I'm a moderate conservative investor today does not necessarily mean I'm going to be a conservative one next year. Perhaps I realized that, well, this is moving a lot slower than I expected, and I take that profile quiz again and I realized, you know what, I'm a more aggressive investor than I thought. Or maybe I started out aggressive and I can't sleep at night. And so I take that test again and I realize I should be more conservative. So you want to make sure you take that test every year because your risk tolerance can change. Perhaps having another child will make you more conservative. Or now you have a mortgage. Maybe you won the lottery. And if you did, kudos to you. In either case, make sure you pay yourself first. The next detail to take into consideration is your designated beneficiary, and that's on the next slide there. Always keep your beneficiary form up to date. Remember, the beneficiary form in your retirement plan supersedes anything else. It supersedes your will, it supersedes your trust. So if you have a living trust that names your children as your primary beneficiary, but your beneficiary form on your retirement plan still has your ex-spouse from 2009, and you've never changed it, well, guess who's going to get the money? It's going to be your ex-spouse. So in the eyes of the courts, it's going to be your will, superseded by your living trust, superseded by your beneficiary form on your retirement plan. So always make sure that's up to date. And then you can go online and just take a look and see who your beneficiary is and make any changes accordingly. And of course, any plan statements you can receive online or by mail as well. Finally, this is our telephone number. In case you have any questions for the future, and that's on the next slide, 1-800-547-7754. Oh, my apologies, it's a different number here. That was Principal's telephone number, but you can also call Pensionmark directly at the number there on your screen. Also, I want to add on the next slide that, I don't know your life story. I know we've gone through one of the, it looks like it was taken out. But we do have on our website a Dream Again. It's called Dream Again. We've gone through one of the worst recessions since the Great Depression. And I'm sure many of you know of a person who has lost a home or has lost their job and they're trying to rebuild their financial future all over again. And if you know somebody like that, or maybe it's yourself, you can go to our website at principal.com/dream. We have a lot of testimonials and a lot of tidbits that you can take with you that will help you figure out how to build your financial future again. And in fact, we have one testimonial of a person who was able to pay off $60,000 in credit card debt just by making some small changes. And you can take everything that's given as an example or just whatever works, but it's there for you to help you from here on forward. And can we go to the next slide just to see what's after? Oh, it looks like it was taken off, but principal.com/dream. And let's actually end with the previous slide with the telephone number on there if we can, Ronnie. That way in case some people did not write it down and they have that information there. But with that said, we'll go ahead and open up for any questions that you may have regarding your the presentation or your retirement plan specifically.
Thank you, Stephen. That was very helpful information. We'll now start addressing some of the questions that have been filtering in. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. As always, for any plan-specific questions, you can also reach out to your dedicated service team at Pensionmark, and that is the number listed on that slide. All right, we will start with our first question. You had mentioned the frequency of rebalancing. We had a question come in saying that they recently read more frequent rebalancing gives an investor more risk management benefits and dollar cost averaging over time. Could you expand on that?
You know, each person is going to be different when it comes to rebalancing. Some people prefer to have it more on an annual basis. Other people are going to prefer quarterly or biannually. Now, rebalancing is going to be different than the dollar cost averaging. What the person means by dollar cost averaging is setting away a certain dollar amount every month or every time they contribute. Let's make it easy, for example. Let's say this person is contributing $100 every paycheck. Dollar cost averaging would make sure that you are contributing or you're investing in the market despite whatever is happening in the market, whether good or bad. So if every purchase costs $10 in the market, at $100 you're able to buy 10 shares. Well, let's say the market went down and every share, instead of being worth $10, is now worth only $5. Well, that sounds pretty bad for your current account balance, but keep in mind that you're able to buy 20 shares instead of 10 shares now. So you're able to buy twice as much with the same dollar amount. And of course, if the market goes up and each share is worth $20 now versus 10, well, you're only able to buy half as much, even though your account balance has gone up in value. So your dollar cost average is absolutely important, but also keep in mind that you want to make sure that you're going to be purchasing one on a continuous basis, but purchasing according to the risk tolerance that you were comfortable with at first. If we start going through another bull market, and the average bull market after a recession typically lasts 26 months, and I think this one ended. Gosh, I forgot when it ended, but we're almost at that time period. Remember, that's your average. Is this a good time to be going aggressive? Who knows? And again, remember, it depends on your risk tolerance. So yes, go ahead and keep your dollar cost averaging, but also keep in mind that you want to rebalance your existing balance. Your dollar cost averaging is for your new contributions, your future contributions. But your rebalancing is going to take into consideration your existing balance. I'm sorry, that went in full circle, but hopefully that kind of answered the question.
Thank you. All right, our next question is, how much would you say is enough for an individual who will retire at age 65 in terms of percentage of salary if they want to keep their current standard of living?
Yeah, that's a very good question. You know, studies suggest that you'll need between 80 to 100% of your current income just to maintain the same lifestyle that you're used to. You'll need 80% of your income if, let's say, for example, you've already paid for your home. You're not going to have all those work-related expenses, not as much wear and tear in your automobile. And hey, guess what? You don't have to save for retirement anymore. So if you were saving 10% for your future, well, you don't have to save that anymore. So there goes away 10%. You may need 100%, however, or more, if let's say, for example, you still have a mortgage you have to pay for, or you have a second home you would like to purchase. Maybe you plan on doing a lot of traveling. You may have a dependent you need to take care of, like a parent. Or I know there's a lot of boomerang children happening now, so you may very well have a child coming back home. So these are different factors you need to take into consideration. So again, the rule of thumb is between 80 to 100% of your existing income to maintain the same lifestyle that you're used to when it comes to retirement.
Thank you. Our next question deals with what is the importance in diversification, or what are your thoughts on commodity funds in retirement plans? How would those best be utilized?
Plays a very commodities play a very important role in having a well-balanced, well-rounded portfolio retirement plan. Remember, let's say, for example, if you had all your money in bonds. Well, if you had all your money in bonds and there was a huge rally in the stock market, you kind of missed that boat. But also, what if you had all your money in stock and we gone through another hard time economically, and the best place to have had your money was in bonds? And that's why it's very important to have a little bit of everything. When we bring commodities into the picture, it plays a very important role as well, because commodities are going to be affected differently, or they have different things that affect commodities than what affects stock, or what affects bonds, or what affects real estate, if you have a real estate commodity. And I'm sure the person is bringing up gold as an example. Yeah, yes, I'm a firm believer in commodities, not in putting 100% of my money in commodities, because what can affect stocks negatively can also affect commodities negatively. So yes, it does play an important role in staying diversified, but it is not the ultimate gospel when it comes to your retirement plan. Let's take, for example, 1980. And I was looking for my chart here. Let's see if I can find it. But in 1980 was the last time was one of the last times that we saw the price of gold skyrocketing. And the price of gold, when we take inflation into consideration, was over $2,100 an ounce back in 1980, during the summer of 1980. And I forget what the dollar amount was at that time period. But within a few months, gold went from, and actually I think it was $800 an ounce, and it dropped down to $200 an ounce. The mistake a lot of people made back in 1980 was that they were buying at the high at $800, only to see it drop down to $200, $250 almost overnight. And those same people did not see their commodity, gold in this example, return for 25 years. Now, currently we're seeing a huge spike in gold. And gold can be an important part, as well as real estate, as well as, say, wheat or corn. But again, it should not represent 100% of anyone's retirement plan.
Great. Thank you, Stefan. I think that's a good point to end this presentation. In the essence of time, I think we'll wrap it up on that point. Again, I'd like to thank everyone for taking the time out of their day to hop on this webinar, and I hope you got a lot out of it. Again, if you have any plan-specific questions, please feel free to reach out to us here at Pensionmark, and we'll get those questions answered for you. And again, Stefan, I'd like to thank you for hosting this webinar and giving us your insights on these investments. And with that, we'll wrap everything up. Thanks.
Thank you.